Welcome to another episode of Autumn Conversations. My name is Andrew and I'm from the Financial Coconut. Autumn is a digital health, wealth, and lifestyle solution that provides users with a fresh, seamless way to manage your finances and aspirations. So download Autumn on the Google Play Store or the Apple App Store. Today's Autumn Conversations, we're going to talk about making smart property investments. And with me, I have the following guest speakers. Let's welcome Samuel Rhee, Chief Investment Officer of Endowus.
Hi, everybody. Great to be here.
Hi, Sam. We also have CEO of Ohmyhome, Rhonda Wong.
Hi, everyone. Rhonda here.
And last but not least, we have Associate Director of Redbrick, Clive Chng.
Hi, everybody. Good morning. Looking forward to our wonderful session.
That's right. So we have Clive, we have Sam, and we have Rhonda, all from different backgrounds. And we're all here to learn more about making property investments. But before that, usually, for a Singaporean, our first property sale purchase is most likely for residential. So Rhonda, could you set the context for us? What are some of the things we have to look out for in purchasing our first property?
Well, if we're purchasing our first property, it really depends on the life stage that we're at. So if this is really your very first one, you're single or just starting out a family, could really think about maybe setting aside a sum of money or funds for this property, knowing that you are going to buy a bigger home in future when your family has expanded. So that also gives you a bit of room to set aside some funds as well for other investments that might yield you faster returns and allow you to have more liquidity. However, if it's your first home, but you're already very well established, you're looking to live in that home for a very long time with your family, then perhaps in order to take advantage of the first home, no ABSD situation, you would want to buy a home that's very comfortable, much larger, a place that you're going to stay put for a long time. So look at your life stage. Of course, look at where you are in terms of your savings, how you want to plan your investments ahead of time. And I think we'll take it from there.
Okay, could you give us a bit more context or a bit more details? Like, is it about my savings? How much do you think we should have in place before we think about purchasing a property? Is there a percentage to it?
Well, generally in Singapore, if you're buying in condos, for example, a studio will cost you about $700,000. So definitely you need to make sure that when it comes to your income, the mortgage shouldn't take up more than 50% of your monthly income. And that's already a very big stretch because that also means that you may not have much, for other investments. So perhaps you should look at about 30% of your income in terms of the monthly mortgage.
Talking about mortgage, let's talk about borrowing. And so we have Clive with us today. From your experience at Redbrick, you know a lot about mortgages. And is it wise to take a bank loan or a HDB loan? What do you think?
My answer is definitely yes, it's wiser to take a bank loan, but it also depends on the circumstances of every individual. It may be different. For example, why do people take HDB loans? Many of them have the mindset that, HDB loans are stable. It's stable at 2.6%. It hasn't moved for the last, maybe 30 years. So, that's something that I want because I want stability. And other people have other circumstances, like if you are a newly married couple and you've just came out onto the workforce with minimal number of years of work experience. So the amount of savings that you might have as compared to someone else who has been in the workforce for 10 years would, of course, be different. So by going for an HDB loan, eases that cash flow. Because if you go for a bank loan, you are required to actually fork out 5% of the initial down payment in cash, right? And some people do not have that cash at the beginning. So opting to go for a HDB loan allows them to own a property with minimal cash down. But that also means that, whatever CPF that they have in their account would most likely be utilized. And this is something that I feel I'm strongly against because, CPF virtually gives you a risk-free return of 2.5. And if you invest your CPF monies, then of course it can give you more, right? So I'm always a fan of taking a bank loan if you can, because number one, interest rates are generally lower than your HDB loans at 2.6%. There are packages in the market, for example, that allows you to hedge for the next 5 years. There's like a 5-year fixed interest rate at 1.65%, even in today's context, right? So just by looking at the first 5 years, you stand to save a tremendous amount of interest, and your outstanding loan amount gets brought down much more significantly if you go for a bank loan. So definitely bank loan for me, and perhaps also there's a very small minority of people that have some misconceptions about taking a bank loan. Some of them may think that, if I take a bank loan, I wouldn't be able to use my CPF to finance my monthly installments, whereas if I go for a HDB loan, I can. Well, that is not true. You can also use your CPF monies, for your monthly repayments. Other clients that I've met say that I don't want to go for a bank loan because that means that I have to fork out another 5% in cash, when I refinance my loan. Well, you don't have to, right? It's only at the beginning when you're purchasing your property that you would have to come out with this 5% in cash. But if you're refinancing in future, then it's just a refinance. You wouldn't need to be, topping up any cash. With the disclaimer, of course, one disclaimer is that if you've taken on an HDB loan, you could have actually gotten a 90% loan, up to 90%, right? So when you move to a bank, for example, that 90% would have to be brought down to either 75 or 80% according to the bank regulations. Then, of course, you're expected to pay down that certain amount to move to the bank. But yeah, I mean, bank loan makes the most sense for me at this point of time.
Right, Clive gave a definitive answer right from the start. Bank loan, and it's due to the current interest rates. Of course, you've given examples of why a HDB loan might be suitable for you. It really depends on your own situation. So like Rhonda said earlier, looking at your own financial health is very important. Rhonda gave a figure. Roughly, you can take about not more than 50% of your monthly income to service your mortgage. Tell us a bit more, Clive, about your debt servicing ratio, TDSR, total debt servicing ratio.
Yeah, so when you purchase a HDB, you're not only subjected to the total debt servicing ratio, you're also subjected to this thing called the MSR, or the mortgage servicing ratio, which also means that, in short, you cannot use more than 30% of your income to service the monthly installment. So these two ratios are kept in check. And the total debt servicing ratio just basically means you are not able to use more than 60%, or all your liabilities added up together cannot exceed 60% of your total income, right?
Okay, hold on there. So what's the difference between the two? So mortgage servicing ratio, it specifically refers to your mortgage. And what's the percentage?
It's 30%. So when you purchase a HDB, the mortgage servicing ratio and the total debt servicing ratio applies to you. However, when you purchase a condo or private property, only the total debt servicing ratio applies, right?
Okay, so and total debt servicing ratio will refer to also like all your loans, credit card, your car payments, etc.
Okay. Yes, that's right. Everything cannot exceed 60% of your income. That's
okay. Right. And thank you for bringing up CPF. So we have Ohmyhome, we have Redbrick. Well, it seems more related to property. And Sam was asking me, what am I here? But that's because we want to hear from Sam's perspective as an investor. But before that, let's talk about CPF first, because Endowus did some branding, right? It's linking Endowus, CPF, Endowus. There's a brand association there. So let's talk about CPF with Sam. What do you think about using CPF to pay for your property? Should you wipe it out, use all CPF? What are the opportunity costs?
Yeah, it's amazing that I'm here even talking about property because I'm not a property guy, but flattered to be here. And you're right. I mean, Endowus is very heavily associated with CPF, obviously being the first and only digital advisor for CPF money. And that puts me in a very difficult situation because property is something that is not naturally something that we do, but it's obviously at the heart of everything every Singaporean thinks about and does when it comes to money. CPF, let's start with what CPF is. I mean, CPF is an amazing total social security system. The fact that you can use this savings for your property down payment or your mortgage servicing is an amazing tool at your disposal. But I would say that just like anything in investing, it really is about each individual's personal circumstances because I think CPF is different things to different people. People are at a different point in their CPF journey as well. Some people might not have anything that they can utilize. Some people might have tons of money in there that they're doing nothing with. And many people will be using it for their property, which I think is appropriate for your ordinary account. Now, when we look at it from an investment perspective, it's always a comparison between, how much can you make investing this money in your OA versus how much money can you make investing it in a property from a purely investment return perspective. And if you look at the historical returns where we are and where we look to the future, the long-term returns for financial investments in financial markets is always going to beat what the property return is going to generate for you. But property means much more than just financial returns for most people. It's an emotional thing. It's about living, it's about our home, which is very different. So it's not purely a financial number that we can, put on this. So when we are buying a property, I think, Rhonda and Clive obviously are much better experts to advise on whether you should use CPF money, whether you should use it for mortgage payments, etc. But from my perspective, I think the most important thing is that what are your other options and what is the opportunity cost? So if you can utilize other cash or other pots of money more effectively versus what you can get from CPF, which is 2.5% guaranteed risk-free, long-term, if you invest in financial markets, you generate a much higher return. Is that going to be better for you because it's the perfect money, monthly savings that you save up and invest for the long term? But if you don't have anything, and this is the only source of down payment for your property, then obviously it has to be the go-to option for every individual because you have this at disposal. Now, there's a cost to it. You have to have that 5% down payment set aside for cash. You have to think about the opportunity cost of servicing mortgages with your CPF, because you're going to eventually have to pay back the CPF that you used and additional interest on top of it. So you're paying back the 2.5 plus the 0.1. So 2.6% has to go back. And this topic will come up when we discuss decoupling. But obviously, when you sell a property, the money goes back to CPF. And that, results in some cash drainage as well. So I think you have to look at it from your personal perspective, and you have to look at it from a holistic perspective and see what the true cost of using that is and compare that to what other options I have.
That's right. So when you sell your property, you have to put back the money that you use from your CPF and also the interest rate that you might have earned if you have not used your CPF at all. And so earlier on, Sam also said that it puts you in a difficult position because I have a feeling that you might want to say that, okay, invest all in Endowus.
We never say that anyway. As we say, it depends on the individual. And some people, it's the perfect tool to invest for the long term. But for others, it's the perfect tool to use for your property. So I think it really is dependent on the individual and where they are in the CPF journey.
That's right. And then also buying your first home is an emotional process. So there are different things to consider. But do you have your own take on how much CPF I should use? For example, should I use all CPF, 50% CPF, 35%? Of course, it depends on the individual situation, but what's your take on it?
Again, I think it is really down to the individual. And really, the bottom line is, do you have any money saved up? Do you have other pots of cash that you can utilize for the down payment piece? That is very clear. Do what you can. If you don't, then utilize CPF, great. Because as you said, your first home is something that, is so emotional and so important to you in your life stage. And so, use your CPF to the max if you can to achieve that dream of yours. But don't overstretch yourself, obviously. Don't go for a house that you cannot afford, to maintain and etc. Don't take unnecessary risk, especially with your first home, is the first thing I would say. The second thing is that for your mortgage payments and ongoing, payments, I always think that the opportunity cost of using CPF is really bad. You should always use cash. You should always, go for a private mortgage and try to lower the interest rate that you pay. And maximize that opportunity. So using it for payments on monthly mortgages, I think is not a great way to utilize your CPF, to be honest. But if you have no other options, and again, it is the only option for you, then yeah, please go ahead.
Rhonda, from your experience at Ohmyhome, what's your take on using CPF?
Everyone uses CPF mainly because there's just not enough cash sitting around, like Sam mentioned. I think that's what we're seeing here. So largely Ohmyhome, we serve a lot of mass market transactions. So from HDB deals to largely your smaller condos or lower price condos. So most of our customers are generally trying to maximize, any amounts of CPF they can use, because the cash amount they still need to save that for their renovation piece. It's kind of not of much of a choice.
Okay, I just want to take this opportunity to welcome those who've just joined this video. Please share it if you found it useful. We're talking about making smart property investments today. We have Rhonda, we have Sam, and we have Clive with us to share more with us about this topic. And so I think we all generally agree that you really need to look at your own finances, because personal finance is very personal. And especially when you're talking about buying property, taking your own financial health in order, making sure that it's in order is really very important. And one of the ways you can do so is through the Autumn app. And through the Autumn app, you can do a financial health check so that you know your financial situation before you decide on a huge purchase like property, because it's going to be a huge capital outlay, right? And one of the huge capital outlay that you might incur in purchasing properties would be stamp duties. And the four-letter word, ABSD, additional buyer's stamp duty. In order to avoid that, some have resorted to using decoupling as a strategy. Rhonda, could you tell us a bit more about this strategy? Do many people decouple from your experience?
Well, it's very, very common because where it comes to decoupling, the main reason is really to save on the buyer's stamp duty on their second property. So really fantastic topic to cover, because it's really so relevant to most of our customers today. So what we're seeing is that if you are looking to save on your stamp duty for your second property, generally couples are decoupling on their first property. So let's say it's a residential property owned by a husband and wife. One of the spouse, so let's say the husband, can buy over the shares of the wife. And the shares that he's buying over from the wife, he'll be paying the standard buyer's stamp duty of about 4%. So it's 1 to 4%, less about 15,400. The wife will then become free of a property. So she'll have no property tied to her name, and is therefore free to purchase another property as a first property in her name. So that means that she will now get to buy the first property, paying the same buyer's stamp duty as a first property and enjoying the LTV of 75%. Now, if they didn't decouple and went ahead as a couple to buy a second property, the second property will have buyer's stamp duty and also ABSD of 12%. So this is a huge difference, for a couple where, 12% cash, to pay for stamp duty is definitely no small amount for properties in Singapore. So the coupling is definitely very popular among the community these days when it comes to real estate transactions.
Is the paperwork complicated? I mean, it sounds easy. It sounds like we all should do this, but what are the costs behind it?
Oh no, it's not complicated. It's no different from buying shares in a company. So it's really just a transfer. Even between families, we see that very commonly. So in the past, we have seen a lot of families, let's say mom and dad decides to buy a property and share it in 3 children's names. These days, they're getting one kid to buy over all the shares so that the other 2 kids will be able to be free of property and then make their own new purchases as a first property again. So you have some legal costs involved, but nothing crazier than your ABSD.
Okay, Clive, from your experience, do many of your clients ask you, okay, how do I decouple? How do I go about doing this?
Maybe 50% of my clients would ask me, 1 in every 2 private property clients would ask me this question. It's something like Rhonda mentioned, very talked about, because everyone is just trying to avoid paying this additional buyer's stamp duty. But I think on top of going on to own more properties, decoupling is a very useful tool. What do I mean by this? Let me give you an example, and this would eventually lead to taking an equity term loan, which we might talk about later as well. So if you are a husband and wife and you own a private property at this point of time, and you have an outstanding loan of, let's say, $500,000, and you've used about $250,000 of CPF on this property, right? So the amount of loan plus CPF is $750,000. Now, if you own a private property, you always have an opportunity to eventually release some equities. If the property has appreciated in capital, you can release that. You can realize that amount. But in such a circumstance, based on the current regulations, this couple in particular is not able to release any monies because they have too much loan and CPF usage. So by decoupling on the property, it depends, of course, on how much CPF each of them have used. By decoupling on the property, we might free up one person's name, and that person realizes that cash and CPF that they've used on the property, and they can then, for example, instead of purchasing another property, utilize the cash and CPF for other investments to diversify. Because we have clients who have owned properties together for maybe 10 years, maybe that's their first matrimonial property, and 10 years before and 10 years later, in terms of earning ability and income, has grown quite a fair bit. Right, so they now both can own one property each, but by decoupling, it frees up the cash and allows them to do other things. There are other instances of decoupling that is deliberately planned beforehand, before purchasing a property. Perhaps let me elaborate. So we all know that if you're a Singapore citizen and you're purchasing the first property, you don't have to pay for additional buyer stamp duty. But if you happen to be a Singapore permanent resident, then the first property you would incur 5% additional buyer stamp duty on the first property. Now, assuming that a couple wants to buy a property each, right? One for their own stay and one for investment, right? And they came up to me and says, Clive, I want to buy one and my wife wants to buy one. My wife is a Singapore PR. And she's looking to buy $1 million property. So that would mean she has to pay $50,000 in additional buyer stamp duty. And we are prepared to pay for this amount of money. But that is not the most efficient way of owning two properties. And this is where a decoupling deliberately comes into play, right? And we structured the loan as such. We structured the mortgage as you buy a property first under both names, and this is a matrimonial property, right? Being a matrimonial property, you do not incur additional buyer stamp duty because one of you is a Singapore citizen. Now, in future, even 6 months or 1 year down the road, for example, you decouple on the property. Now, you can choose how you'd like to hold the property, the amount of shares you want to hold in the property. So, for instance, in this case, we structure it as the wife, who is a Singapore PR, holds 99% of the share, and the husband, who is a Singapore citizen, holds 1% of the share. Now, eventually, what's going to happen? The wife would purchase over the husband's share. And when she does that, she has to pay for buyer stamp duty. And because she's a Singapore PR, she pays for additional buyer stamp duty. But the amount of buyer stamp duty and additional buyer stamp duty is only charged on 1% of the purchase price. Assuming that the valuation of the property is $1 million, buyer stamp duty on 1% is $100. Additional buyer stamp duty of 5% is $500. So just by doing this itself, right, deliberately decoupling, you own two properties at the end of the day, but in a more efficient manner. You don't pay as much additional buyer stamp duty. So these are the tools that people employ today in the market deliberately as well to basically streamline their purchases.
Okay, so and this is all pre-planned in advance. Even before buying your first property, you're already planning years ahead. In the event that we're going to be a second property, this is what is going to happen. Well, it sounds pretty straightforward. I mean, from both Rhonda and Clive's sharing. Sam, what do you think? Are there things that we should consider before we do coupling from your own personal perspective? Does it affect loans? Does it affect your CPF? All right, Sam, we need to... that's right.
Yeah, I think from a personal perspective, I think decoupling is a great option that people should definitely consider. When it comes to loans and CPF and alternative to investments and the other areas, it's a lot more complicated. And especially when it comes to CPF, it's even more complicated because when you decouple, there are many other considerations. And I think the one thing that people forget is there are other costs associated with decoupling. And there are very unique circumstances within a CPF if you've used CPF as a part of that payment. So if you decouple and you sell, then obviously you have to return that money back to CPF with the interest. You have to, if you're above 55, you have to top up your retirement scheme before you can actually use it again. So there's some limitations that are very specific to CPF. Also, you have to pay back the interest, as we said before, which means that some of the proceeds may not be used, and you will have to top up the 5% down payment again for a new property if you're investing in a second property, for example. So and other stuff like seller stamp duty or conveyancing and other mortgage, all this additional costs do exist. So I think everybody has to calculate their own personal circumstances what their situation is with regards to their mortgage, whether there's any penalties, for example, what are you doing actually with your CPF, whether you're going to utilize it again, whether couples have enough CPF OA to use even. So the other trend is that some people don't have enough, or they're older and they have to top up the retirement scheme. So the reverse trend of decoupling in order to utilize their OA as a couple for a down payment for another home, that's also happening as well. So there's multiple different dimensions to this, and everybody needs to be aware of their personal circumstances and how they're using it for CPF specifically.
Tell us a bit about the reverse trend of decoupling. So what situation caused them to want to do that?
Actually, I don't know too much about it, but within the CPF context, I think it's people like if a couple doesn't have enough OA, especially if you're older and you have to top up your retirement scheme, whether you're a basic retirement or a full retirement. And as a result, especially beyond 55, you don't have enough as an individual to use your OA, then you actually recouple and pull the balance of your OA so that you can put the down payment for another house or a new house. So I think that's the decoupling angle that I've heard of. I'm sure it's not a very common case, but yeah. So everybody's different is my point, I think, even with
definitely something to consider. And also everybody's different, like what you're saying. So really knowing your finances helps a lot, especially in purchasing properties. So we talk a bit about buying property for your own home and also buying properties as an investment. Definitely, you should really check out your own financial health before you make such a decision. Well, let's talk about property as an investment. We've brought it up, and we want to really go deeper into it. There's a DBS report that suggests that buying property might not be the best retirement investment. And the report compares it to buying equities, investing S&P 500, REITs, etc. And well, it seems that, there are opportunities out there. And earlier on also, Sam brought it up that you really have to compare with other asset classes in deciding whether property is really your go-to investment for your retirement. So what do you think, Sam?
Yeah, this is a really controversial topic, obviously. But, when it comes to investing, I think we have to start with, again, where you are as an individual. And you have to look at your financial situation holistically. I think in Singapore, obviously, we have a lot of overweight position in real estate traditionally. And also we have a lot of barbell strategies where you do extreme one real estate, the other side fixed deposits. So one is risky, they think, and the other one is completely risk-free. And probably that's not the best strategy, especially these days with fixed deposits giving you absolutely zero returns. And if you think about the cost of living that's rising, that's called inflation, and that averages above 2% historically, then you're actually, by keeping it in deposits, you're getting a negative return. And so if you think about how you manage your finances, you have to really look at it holistically and think about how you're asset allocating. Property is definitely a key feature of it, but obviously financial investments should be another really important allocation. And when comparing between the two, financial markets have trumped real estate returns over long periods of time. So people, again, look at just the numbers and say, well, financial investments should always be better. But properties, as we've ascertained, is much more than that. It's emotional. Your dream of a first home is really important to people. And I think within the asset allocation, property has a place to play. Long-term property returns have not done as well, especially if you think about what the impact of H2B investing is. And when we bring in retirement as well into that, then it completely changes the picture. Because HDB in particular, many people think it will go to zero, right? And there's reverse mortgages that are being made available, which is making people a little bit uncertain or worried. Because when it comes to property, for most people, it's something that is for life. It's something that you want to pass on to the next generation. It's an asset that you should hold on to. But with HDBs, if you're going to have to reverse mortgage and draw it down to zero in your retirement, or the value actually deteriorates because it's aging, then it's not a good place for you to be storing value or storing wealth for your retirement and for future generations. So private property and HDB, again, is a different scenario. And then finally, in financial investments, I think that, while numbers may look good, obviously there is something called volatility. So when you're making financial market investments, markets could be up 25% this year, down 10% next year. So there's more volatility compared to properties and other illiquid investments, which don't fluctuate because the pricing is not going to be moving up and down so dramatically. And so that's the other consideration you need to make, because as an individual, everybody's risk appetite is very different. So some people can live through that volatility and grow wealth over the long term by making financial investments in financial markets. But for other people, the stability of property prices not being so volatile is really important to them. So I think that long term, things average out. So financial markets, while it's volatile in the short term, gives you long-term good returns. So it's really important to have that perspective of time and invest for the long term in order to gain the benefits of investing in financial markets. So the average return can be gained if you invest for 5, 10, 15 years. But if you're investing for 1 month or 6 months or 1 year, then you may not get the average return. It may be up 25% and do great, but it could also be down. So I think that's the kind of reality that we need to understand. What is your own personal risk appetite? Where does financial investments and where does property sit in your overall asset allocation? And everybody, I think, needs to do that assessment themselves and make a suitable decision that is right for them.
So there's no clear-cut answer to say that property is better than another form of investment, because ultimately it depends on yourself. And actually, Sam provided a few angles to approach this. For example, volatility, how much of a risk appetite do you have, and also your time frame. Well, in the same DBS report, of course, like all other reports, there are limitations inbuilt into the study. And also the study suggests that it shows that the majority of Singaporeans' assets are in properties, cash, and CPF. Rhonda, what do you think? Are you surprised by this finding?
No, I think it completely makes sense because Singapore property prices are so high. So it definitely makes sense that it is the majority of our wealth. Well, we saw in the report, Singapore property prices are 15 times our annual income. So I think there's no chance that it will be a minority of our wealth allocation. It's true, rental yields are low. It's getting harder and harder to make rental income in residential assets, especially. Also with the, ABSD, if the focus is still remaining on residential, definitely there's an impact there. But where we are also missing out on is the capital appreciation. So across the year, we have seen across the segments of HDB, condos, and especially landed properties, the price increment has been phenomenal in just this year alone. Well, there is a lot of wealth aggregated here in Singapore. We have tons of family offices locating their HQ here. That's tech wealth, there's foreign funds. So I think Singapore as a country is actually doing very well in terms of attracting all of these intelligent funds into the country. And because of that also, because of how the government has structured the ABSD, you will also find that the old wealth that we used to hear about where, they leave legacy planning, like Sam mentioned, sharing a portfolio with their next generation. We will start seeing less of that, apart from those with commercial properties, because we're seeing that, people are starting to feel like with ABSD in place, maybe it's not such a good option, buying up assets anymore. So it forces people to turn to other forms of investments that may be more liquid, less tax, easier to transfer. But we can never forget the part about the emotional aspect that Sam also mentioned. Real estate is real, it's physical, it's a house, people live there, people love it for the view, the way, the location. So there are all this intrinsic value that just cannot be replaced by other financial products, regardless of how incredible the returns may be. So when it comes to that, we notice that customers are also coming back to us, asking us, hey, I can't afford a second property or a third property in Singapore. Where else can we go? So even before, Ohmyhome, we've seen tons of customers going over the borders to Malaysia. There was at one point a report that 60% of Iskandar properties are bought up by Singaporeans. But you realize that there isn't a complete solution. It's easy to buy, you place your money there, and then when the property is ready, who's going to maintain it? Who's going to lease it out? Who's going to manage it for you? So this is why Ohmyhome, we have set out to be a seamless cross-border transaction platform as well. Today, we're in Singapore, KL, Malaysia, as well as Philippines. And what that means is that regardless of wherever you are in the world, you can purchase properties in these 3 countries through Ohmyhome. And not just purchasing, we will also take care of your rental, your lease and all the maintenance after. So it becomes more hassle-free. And every single day as we work towards our vision, it's really how we can provide this trusted and comprehensive solution for everyone. So if you look at just an example of, if you place 100,000 Sing dollars in the Philippines real estate market about 5 years ago, today it would be worth anywhere between 120,000 to 200,000. Well, that's very good returns, only if you can capture it, meaning you can actually sell it off and receive the cash. You have to take into account the Forex cost, maintenance cost, and any other cost that may be incurred along the way. But with Ohmyhome, we're going to keep it simple and we'll keep growing this way.
Okay, so property as an investment, there's also the option of overseas properties. Moving back closer to home, Clive, do you have anything to add? How should we optimize our property investment strategies?
Yeah, I think both Sam and Rhonda have covered really, really relevant points. And I do agree with each of them. And I also, when people talk to us, because we are in the property space, me and Rhonda, everyone is thinking about, hey, we have cash, we should buy property, we should buy property, we should buy property. Even ourselves as property investors, we don't do that, right? We don't pump all our monies into properties and we don't have any other investments. No, we don't do that. As investors, it's always important to diversify between different asset classes. And this is something that I think the mass market is, maybe in terms of education wise, they're not yet educated, because traditionally Asians gravitate towards buying properties. Traditionally, our parents would have made monies off properties. You could have bought a landed property last time for $100,000, $200,000, and now it's worth $1 million, $2 million, right? So and not forgetting, in 2017 and 2018, when we had the en bloc fever, overnight people became millionaires. I was talking to a client of mine who's 56 years old. He's staying in HUDC, right? He's a technician, has been working in the company for over 30 years, drawing an income of $5,000. And all of a sudden, he's a millionaire, right? And there are so many people like him his neighbors were all like him. And all of them have that belief that buying properties is definitely the way to go. So if I have cash, I want to invest it in properties. So that's something that we constantly tell our clients as well. Like, hey, you know what? Although we are in this space, you got to look at diversification across different asset classes, like what Sam mentioned as well, investing in other sorts of investments to grow your wealth. But yeah, traditionally, there is still opportunities in the property market, although not as much as what we've seen in the past because of stricter regulations right now. But yeah, I think properties in a way, how many investors are looking at it right now is like a stepping stone, right? So not only, for example, let's take landed properties, for example, not only are landed properties, freehold properties, a good store of wealth, but there's an opportunity that you can use these properties as a stepping stone to help you, grow your other investments through unlocking or releasing equities. After holding it for X number of years, the property appreciates in value. You're able to tap on that profits, while staying in the property. And when you have that at a cost of a fraction, like you can release $400,000, $500,000, $600,000 at less than 2% interest rates. To an investor, it's free money, right? And then I use this money and I put it in, different investments that grow my returns double digits. It makes a lot of sense. So it's like a stepping stone. And property, like what Sam said, property prices are not that volatile. At the end of the day, we know that we still can fall back on our property. There's still a roof over our heads. So that way, that's how people view properties. A lot of people view properties this way as well. But yeah, traditionally, a large majority of people still think that, I'm not too sure, where should I put my money? What is an ETF? What is Bitcoin? I know Bitcoin is going up. What is blockchain? I don't know all these things. I'm just going with the flow. My friends are all buying property. So yeah, I'll just buy a property. I bought a BTO 5 years ago at $400,000. I'm selling it 5 years later at $700,000. Wow, $300,000 over 5 years. That's quite a good return. So I think I should, continue to invest in property. This is what the mindset that people have. But I would say, this of course comes at there's a disclaimer. Not all properties behave like this in Singapore. Rental yields are something that has always been lackluster in the residential market. And for that reason, a lot more people have been exploring moving into commercial or even industrial properties, for returns, for better returns. So there are many things we can do to our properties to help us leverage but the most important thing is, I want to say again, that property is not the only form of investment that you're supposed to put all your monies in. You should diversify. You should place your funds in other investments to help you grow. I totally agree with Sam as well that, in the longer run, monies being placed in the financial markets will definitely the returns that you will get will definitely be better than what you experience in properties. So yeah, that's my take on that.
Okay, thank you. Thank you to all three of you for sharing. Let's take a look at the Q&A. We've collected these questions on social media. I'm 33 and getting married soon. Should we aim high and go for the condo my wife wants, or just stick to a HDB for our first property? Clive, would you like to take this question?
Happy wife, happy life. If your wife loves, I think that's the best piece of advice. If your wife loves the condo, okay, let's seriously speaking, it really depends, on your financial position at this point of time. I would say, buying into HDB, you are subjected to the 5-year minimum occupation period. You got to realize that now you're 33. By the time you are able to sell the HDB, you'll be 38. Within this 5 years, where are you gonna go? What's your income going to be like? If it's not too much of a stretch, then I'd say go into a condo, right? Don't over leverage, of course, but go into a condo because it offers you flexibilities to do a lot of things, like a decoupling, like an equity term loan, where you can then recycle the funds and put it into the financial market. Not just into properties. But with HDBs, it's definitely more affordable. Right, it doesn't. You're not too worried about the monthly repayments for the next 5 years. But at the end of the day, it is still something that the government would not want you to. The government doesn't want you to look at HDBs as an investment tool. That's what they stress for in many instances. So if I were him in this instance, 33 years old, if I can afford it, I'll move into a condo. And the byproduct is my wife is happy. Yeah.
Right, so tracking on finances, making sure your wife is happy. Got it. Next question, I'd like to address it to Sam because it's a CPF question. Although my CPF can pay for the cost of the flat I'm planning to apply for in Kallang, I'm planning to still apply for a loan instead, so I can keep some of my CPF to generate interest. So it's an opportunity cost. Is this wise?
Okay, first of all, I would like to thank Clive for the shout out to diversification, because I think it's so important. In financial theory, asset allocation determines almost 90% returns. So where you asset allocate is really important. So when I said, look at your circumstances and, have that asset allocation holistically, that's really important. But the other really important thing is diversification. And diversification means many things to different people. But even within property, as Clive said, you can, from residential, considering commercial or industrial exposure, that's diversification. HDB to private condo, that could be diversification for some people. And as Rhonda highlighted, Singapore to overseas properties, that's diversification too. So it works in different ways. But what people do sometimes is they buy property, HDB, and then private condo. And then for financial investments, they invest in REITs and they buy Singapore REITs. So that's not diversification, guys. The REITs is somewhat of a diversification, but it's really important that you are diversified, not only in terms of the asset class, but in terms of geography, in terms of the source of returns over the long term, whether it's short-term returns or long-term returns, etc. So I think that's really important to highlight. And that's really why I think, whether you take out a loan or use your CPF is also about what are you going to use it for, and what are the alternatives of using your CPF. Now, it's interesting, the question mentioned, should I keep my CPF to generate interest? And this concept, I think we need to get over. The 2.5% that CPF OA is giving you is great. I mean, don't get me wrong, it's a great number because you can't get it elsewhere. But it's really important when you don't want to take risk with that money, and you can get better than fixed deposit rates. And that only applies to you if you're 55 and 65 or in retirement. You can continue to use your CPF OA as a pot of cash like deposits. You can take the money out anytime you want beyond that age, and you can generate 2.5% risk-free. Amazing. But when you're younger and you have monthly savings coming in from your CPF or your OA, and you're pooling money and you're building wealth for the long term and preparing for retirement, 2.5%, guys, is just not enough. It's barely above inflation. We should be asking much more of your money than just interest. So, cash should work harder for you. I mean, don't put it in fixed deposits. A plug. Endowus generated this product called Cash Smart because our clients said, hey, is there any way I can take lower risk and generate higher yield? We offer 0.78% for virtually risk-free, 1% plus for a little bit of risk, but really not much volatility. And you can do that. And so I don't keep more than a month, need of expenses in the bank deposit because I put it all in Cash Smart and make my cash work harder by generating even 1%. Amazing. But long term, if you're building wealth and preparing for retirement, you really need to do much better because you need to take advantage of the long time frame you have. The fact that you're earning income, that you're committing every month to building wealth. And if you put that to work in the right way in financial markets, that will compound over the long term and really grow wealth for you well beyond the cost of living and inflation. And that's what you need to do. So it's really important that you plan this out over the long term. And CPF is a great tool to use, especially for your OA, to allocate to that long-term growth and allocation. So I would really applaud this person for using a loan. Maximize your loan to value, especially when interest rates are low. Maybe not use your CPF. And if you have cash, then you should use that.
Thank you, Sam. We have one last question, and it's about renting. We haven't covered much about renting today, so let's take some time to talk about renting. Is renting a bad move overall? I'm afraid to spend so much on a property, but renting is like draining my finances on something that I won't own anyway. Rhonda, your thoughts?
I rented in my earlier years. So I think when I first came back to Singapore, with my first pot of cash that I had, I actually invested in a property. And then I rented a small place. So that allows me to have like a net positive return. So every month I collect my rent or, hopefully it makes capital appreciation. Those were days without ABSD. We could sell properties anytime we'd like to. So I rented for a few years in those days. But fast forward to today, if you are renting, it could make sense too. So let's say you have $50,000. You could place that $50,000 into a down payment for a property that you will live in, which means that will not make money for you during the time that you're living in there. Or you could rent a property and then use that $50,000 to invest in something else that could yield you better returns. So I think it also really depends on the stage of life that you're at. How much savings do you have? If you have ample amount of savings, of course, you could buy a property, you could, diversify. But if 50 grand is all you have, then you have to really think harder on, if you invest in a property today, regardless of actually, even if it's not HDB, you still have to hold it for at least 4 years to avoid the seller stamp duty. So do you want to lock that 50 grand, for 4 or 5 years? Or do you think that your 50 grand can do better elsewhere? And, today we have such great sharing from, Clive and Sam to look at where that 50 grand can go to. Now, 5 years later, now maybe you don't have just 50 grand, maybe you have 200 grand. Now that's very different. Now you can have a allocation of like, oh, I can have property and something else too, So I think it's really okay to rent. I don't think it's a bad move. Your landlord is not making so much from your rent anyway, maybe not even enough to pay their mortgage, so you're not paying too much rent.
Thank you, Rhonda. Definitely something to think about. We've come to the end of today's Autumn Conversations. So today we're talking about property. And before your first property purchase, you might want to check out your financial situation. And with that, you can use the Autumn app. Autumn pulls data from all the different bank accounts, your loans, your CPF, so that you can have a one-stop access to your financial situation. Download the Autumn app on the Google Play Store or the Apple App Store. Thank you, Rhonda. Thank you, Sam. And thank you, Clive, for joining us today. And thank you to the audience for staying with us. See you on the next Autumn Conversations. Bye-bye.
Guys, bye-bye.